Hi everybody, this is Alan Ellman, the Blue Collar Investor, welcoming you to the Beginner's Corner information series. This topic is selling cash secured puts. Now this is lesson 1 of an 8-part video series, and in lesson 1 we will be discussing what exactly is selling cash secured puts. We're going to give an introduction and then a preview example with 2 possible major outcomes. Now, selling cash secured puts is defined as an investment strategy that combines selling put options while simultaneously placing enough cash in the broker account to buy the stock if the put option is exercised and those shares are in fact sold to us. So it's a 2-step process. Now, a stock, as you know, is a unit of ownership in a corporation. And since we are undertaking the put obligation and we may end up owning these shares, we should only sell puts on stocks that we would otherwise want to own in our portfolio. So a put option is a contract that gives the holder or the buyer the right but not the obligation to sell their shares to us at a particular price called the strike price by a particular date known as the expiration date. Let's break down the 4 words in the term selling cash secured puts. Selling means that we are writing or initiating the contract. It's known as selling to open, STO. And we will be receiving a cash premium for undertaking the option obligation. Cash secured means that we're placing the appropriate amount of cash into our brokerage account to pay for a possible future stock transaction. In other words, if the put buyer elects to exercise that option and sell their shares to us, we must have enough cash in the broker account to pay for those shares. And finally, the word put is the type of option that we are selling. Once again, we are selling the right but not the obligation for some unknown person to sell us their shares of stock at a particular price known as the strike price by a particular date known as the expiration date. Let's go with a preview example. Let's assume for a moment that BCI Corporation is trading at $32 per share. We then sell the put option. We agree to buy the stock at $30 at any time over the next 1 month. Now, $30 strike price in put terminology is called an out-of-the-money strike, lower than the current market value. A typical premium in a scenario like this would be about $1 per share or $100 for the entire contract. One options contract almost always consists of 100 shares of the underlying security, whether it's a stock or an exchange-traded fund. We then secure the put sale by placing an appropriate amount of cash into our brokerage account. Well, if we're agreeing to buy 100 shares at $30, that's $3,000. But our broker will allow us to apply the put premium to that amount. So the amount of cash that we actually have to put into our account is then $2,900, the $3,000 minus the $100 put premium. Now, a $100 initial profit on a cost basis of $2,900 represents a 3.4% 1-month initial return. That is, if the option is not exercised. Now, during this contract and at the end of the contract, there are 2 possible major outcomes. One, if the stock price remains above the $30 strike price, and the other, if the stock price moves below the $30 strike price. So let's break down those 2 possible major outcomes. If the price of the stock remains above 30, the option buyer will not exercise. Let's understand why. He has the right to sell his shares to us at $30. If the price of the stock remains above 30, let's say it stays at 32, why would he sell his shares to us at 30 if they could be sold at market for 32? That will not happen. So the option expires worthless. We keep the 3.4% 1-month return. That now frees up the cash to secure another put in the following month. Now, the other possible major outcome will occur if the price of the stock moves below the $30 strike price. In that case, the option buyer will exercise his right to sell his shares to us at $30 per share. Now, if that happens, we buy the shares at $30 less the put premium of $1, so our cost basis is then $29 per share. Some investors allude to this as buying a stock at a discount. So what is the discount? Well, the stock was trading at $32, we bought it for $29, so from a $32 initial price, that represents a discount of 9.4%. So the next question that comes to mind is, well, everything sounds great so far. Is there any risk? And the answer is, of course there's risk. Anytime you try to get more than a risk-free return on investment, that means that you and I are incurring some form of risk. And the risk in this case is in the price of the stock dropping below the break-even of $29. If that happens, we could start to lose money. And so we have to keep an eye on the break-even, and we have to be prepared with management techniques, exit strategies, if that in fact does happen. So the three critical aspects of this strategy is stock selection. Which underlying security are you going to sell the put on? Remember, those shares may be put or sold to us, so they should be shares that we would otherwise want to own in our portfolio. Which option strike price are we going to select? That's very important. And finally, we have to have the management skills to mitigate losses, turn losses into gains, and in some case, enhance gains to even higher levels. So let's summarize lesson 1 for selling cash secured puts. It's a conservative cash generating strategy that combines stock selection, cash deposits, and option selling. Now, stock selection, option selection, and position management are the three skills that we absolutely must master before we even think about risking one penny of our hard-earned money. Okay, that's it for lesson 1. In lesson 2, we're going to discuss the basics of options. Thanks for listening. Hope you enjoyed it. See you at lesson 2. Take care, everybody.